Break down today's action. UD Chang, Ace Investment Strategist, chief trader, with the three biggest risks that he sees toward the market. And you got to listen because this guy's usually very bullish. Michael Busio, FBB Capital Partners portfolio manager, is here with names you should add to your portfolio right now that he loves. And Lincoln Ellis, Green Square Capital managing director in the pits of the CME. Lincoln, it's ridiculous to say. Does today give us any kind of indication how the second half will go? But did we see any portending of any trends?
No, probably not. I mean, given the fact that this week, this shortened week, is absolutely packed with a bunch of macroeconomic data, especially the jobs number that comes out on Thursday before the long holiday, I think people are really positioning themselves to digest a whole series of data, ISM manufacturing and non-manufacturing, PMIs overnight on a global basis, and then, of course, 3 days' worth of jobs numbers, which will give us a sense of the backdrop on which we got some kind of, mixed durable goods numbers and a really a tepid sense of what the economy's actually capable of.
Yudi, I went back into Factiva because I was curious about what you said about the economy going into the first quarter. In December of 2013, you actually did warn. You were bullish in the market, but you warned about economic growth. But did you see a 3% or almost 3% decline in that growth?
Absolutely not. I thought growth would be somewhere around 1% up, not 3% decline. However, going forward, now people are getting bullish again, right?
But how
Another
much,
3%.
excuse me for interrupting you, how much are we going to have to bounce back just to get to normal?
Yeah, a lot. That's the problem. I think that's just one of the unknowns, that the risk that we have in the so-called economy. Right now, most people are pretty optimistic, saying that, hey, first quarter, due to weather, due to all other factors, okay, we're going to dismiss that. But second quarter should pick up maybe with a 3%. But if somehow we have these unknown risks, then it's going to be really a shocker to the stock market.
A shocker to the stock market. But, Michael, what do you do between then and now? You'd remain frozen, or are there picks we should be adding to our portfolio that'll help at that time?
No, we think that you should be adding stocks to your portfolio, particularly if you're heavy on cash. We think that the market is probably going to continue to grind higher. We've been in this slow and low theme for a few years, where we think that economic activity is going to continue to be slow growth and low interest rates. And in that environment, when you're looking at relative value between stocks and bonds, we prefer a company that's paying us a 3% dividend yield that's growing year over year than a 2.5% 10-year Treasury.
Lincoln, let's face it, one thing that is facing everybody is the fact that part of our economic environment is unreal. I mean, these interest rates are not real interest rates. They are artificially low. They've been artificially low now for about 3 or 4 years. That's creating some aberration. One is for the shadow banking community. I know the Attorney General of New York is stepping in, trying to monitor that a little more closely. But why is it growing so much now, and what effect is it going to have on the overall market?
Well, look, when you shut off the regular activities of the banking system more largely, and you have forced lending activities, particularly into middle and small companies, out into the private markets, you're going to have some distortions or some opportunities migrate out of the normal channels. I'd like to point out that it's actually interesting to see that while we're in this twilight zone of stocks continuing to grind higher and rates artificially low, that the defensive part of all the major indices have continued to perform really well. Utilities on this last day of the quarter being one of the best performers.
Well, let me just, Yudi and Michael, you have both picked energy names, whether they're energy services or integrated oils, for the picks today. And I think that's interesting because right behind utilities are energy and services. Yudi, you like Apache. Michael, you like ConocoPhillips. Yudi, do you stay with Apache? I mean, what worked in the first half? Does it continue to work in the second half?
Well, not necessarily all names, but in the case of the energy one, Apache, I think it does. I expect higher energy prices, and also I'm looking for these companies such as Apache has excellent profit margins comparing to its peers. And also with Apache, there's a special reason as well. Their recent asset sales, I think they're being a little bit underestimated by the market participant. That's why I like Apache.
Okay, why do you like ConocoPhillips, Michael?
Yeah, so Conoco, 2 years ago, spun off Phillips, so the refining business. So it's
so I
back
should
to
just
kind of
call
an
it Conoco. You're right, yeah.
Right, E&P play, 3.25% dividend almost. That dividend is twice what it was 5 years ago with the combined company. Strong balance sheet, low debt to total capital, and while they're figuring out revenues to grow, they're continuing to return capital to shareholders, which we like. We like that cash flow, either reinvested back in the business, buying another business, buying back stock, or paying dividends and raising those dividends over time, and Conoco is certainly doing that.
Yudi, we were just talking about banking and finance, and we haven't talked a lot about consumer credit because it got under control. It was totally out of control in 2007-8, got under control, but there is room to grow in consumer credit, and there is a company, Capital One, which is just primed for that movement, right?
Absolutely. It's been doing well, and I think it will continue to do well. Basically, Capital One is a leader in its own sector, which is the consumer credit / credit cards. But recently, they're starting to move into the small business and also consumer loan, construction loan arena. I think they'll continue to do well. And also, a little point of view, where people are keep talking about this market going higher, but if you look at it, the market maybe as a whole is higher. Out of the S&P 500 stocks, 138, that's 28%, are either flat or down for the year. So we are in a correction consolidation right now.
Well, a correction consolidation. On the other hand, you look at the rise in the market compared to what has happened in the economy, and people say there's a disconnect, Yudi.
True, absolutely true. That's why I think Friday's unemployment report is pretty important. We want to see right now so
comes
far.
out Thursday.
I'm sorry, you're absolutely correct. Thursday. Right now, traders are looking at these economic data as glass half full, right? So they're saying lesser robust data, lesser aggressive Fed. That's good. But we do need to see stronger economy to support continuous gain in the stock market. That's why your question, David, is absolutely right. Eventually, we've got to see a robust economy for the market to continuously rise.
Yeah, well, we'll not hold our breath because it's not happening right now. Lincoln, as we finish out, does China have what we don't? I mean, China certainly has had a soft landing. I think that's fair to say. Where do you see that, and will it be a driver of our growth? Will their consumers start to utilize or buy up what we make at some point?
Right. So you have to look at these. The global growth engines in general have been broken, and if you look at policy flexibility, obviously China has a lot of policy flexibility, probably first, even above and beyond what the ECB has done in terms of rerouting and reorganizing the financial sector in order to engineer that soft landing. It's our demand that's actually the trouble for China. We have not yet gotten to a place in GDP growth really reflects that, where middle class and lower middle class Americans, or broadly middle-class folks in the developed economies, have gotten back to a consumptive level that would actually drive a next stage of GDP growth in China that would actually re-accelerate or re-spark emerging market growth to the levels that we had seen, probably artificially somewhat, in the early 2000s.
Well, none of you guys mentioned Twitter, but there's some news on Twitter we should get to right now because it is moving the stock slightly. And after hours, Twitter has made an acquisition. Twitter is acquiring mobile ad tech startup. It's called Tap Commerce. And what it does, in essence, is it specializes in ad retargeting for all those app makers out there, David. I mean, the app makers are an engine unto themselves. They're a cottage industry unto themselves that become billions and billions.
Of course, it's not moving the market much. After hours, we see the bid is actually down a tick from where it closed at the day. We'll have to wait and see what happens to the stock tomorrow. Guys, thank you very much.
Jolene Kent is working on the story right now. She'll be up to tell us more about the Tap acquisition, so stay tuned.
So it sounds like the plot of a science fiction